you should be building relationships 24/7 with all the fund managers. Don't negate being put in touch with analysts, associates within the firm either. They have a huge say. And I think that, founders tend to always reach out to the partners. They're the ones with the least amount of bandwidth and will be least likely to respond. Are you doing this because you're trying to build kind of a billion-dollar business? Or are you doing this because you're really passionate about the space and this is almost like a lifestyle choice for you? This is what you want to do for the long term. This is going to be your legacy. I think my role kind of, in this planet or in this realm is really to help connect people. And so if I have access to people that would be helpful to, for example, an entrepreneur's journey, I will connect them. If you have at least a subset of investors on that cap table that you feel comfortable, just pick up the phone and be like, listen, I'm really struggling with this professionally, or even I'm really struggling with this personally and it's affecting my work. That is key. And if you don't have any of those on your cap table, it's a bit worrisome, to be honest. My advice to founders is, unless you need to fundraise, don't fundraise. Use us, let us roll up our sleeves and help you, whether it be on the fundraising side or on the customer side or the strategic side, etc.
Hello, and welcome to Lucidity Insights podcast, The Perfect Pitch. I'm Erica Welch, the Chief Content Officer of Lucidity Insights and your host, and I'm so excited today because I have Sonia Weymuller with me. She is the co-founder and general partner at VentureSouq and all things climate tech and sustainability as well, so we'll try and touch on that as well. Welcome.
Thank you so much for having me, Erica.
Super excited to have you for this conversation. So before we dive into the whole VC landscape and all this advice you have for founders here to approach you and ask you for money.
Great.
Tell me about the woman sitting here. I've heard before that you actually wanted to be a journalist.
Yes.
You got a degree in political science at Yale.
Yep.
You started your career in strategy and M&A, both at Microsoft and then Viacom, and I think one other place. And then somehow you started angel investing on the side, which I'm super curious about, which then turned into VentureSouq. Correct?
Correct.
Okay, so tell me a little bit about, with 2020 hindsight, as you look at your career, you go, yeah, it makes sense that I ended up in the seat that I'm in now.
It made total sense that I ended up where I am today. As you rightly said, I did study poli-sci, undergrad and grad, actually school as well. I think I was going to be a journalist. Started my career at Microsoft in London.
How was that transition? Because you wanted
I got
to be
a job.
journalist?
I was living in London, expensive city to live in. I realized I needed to make money, and I got a job while I was studying. That's how it started. Yeah. It was pure practicality. Sonia is in London. Sonia needs to make money to pay bills.
Were you looking for journalist jobs still at that point? Or?
No, actually, I wasn't. I should have. I think the Microsoft gig kind of happened, organically through my Yale network, actually. So one of my friends was heading up the strategy M&A team and was like, hey, if you want, you can join us. We're working on some interesting stuff, and you can get some experience and see where it goes. So I kept an open mind. I think that is one thing when I reflect back is that I always kept an open mind. I never was that girl who had a 5-year plan of okay, I'm going to graduate from university, then I'm going to go straight to McKinsey or BCG, and then I'm going to do this for 4 years, and then I'm going to go somewhere else. So I always, I think, kept an open mind, even though I knew I had a strong interest, specifically in the intersection of politics and media at the time. And that's what I studied. My philosophy in life is just to keep an open mind. And so that's why I kind of accepted. I was like, okay, this will be interesting. And I believe anything you do in life, you'll find a learning out of it anyway, right? But then, yes, little did I know that it was going to kind of push me in one direction, which ended up being more on the strategy side amongst various media mammoth organizations. So obviously Microsoft won, Viacom, and then Turner was the third. And so I grew with them basically on the strategy side, which I think formed me well for what I'm doing right now because it is strategic. Investing is strategic as well, right? And so if anything, I think it helped craft kind of my zone of genius of sitting down with founders and understanding strategically what they're trying to accomplish. So it does make sense. I knew at the time that I didn't want to be in front of a laptop, in front of an Excel sheet 24/7. Like I'm definitely more of a people's person as well. And so I think that lent itself well into what I'm doing right now too.
I love that. Your zone of genius. I love that. That's like your superpower, right? What is your zone of genius?
I would say my zone of genius is connecting. I think some of us are fortunate to have various networks across different geographies, different sectors, etc. And so, not to sound like grandiose, but like when thinking about like the why of like, why am I here? I think my role kind of, in this planet or in this realm is really to help connect people. And so if I have access to people that would be helpful to, for example, an entrepreneur's journey, like I will connect them. It goes beyond work though, to be honest. Even on as we're having this conversation, like, my brain will be in overdrive. I'll be thinking, oh, Erica should meet so-and-so, so-and-so. And like, maybe there's a synergy there, etc. And so I think that's back to the zone of genius. That's my zone of genius. It's kind of almost being like a human router. Finds kind of these connections between different topics or different people. And then I don't know where those conversations will go. I'm just there to strike that connection and, and then it's off to the races for those individuals.
I love that. I had a couple mentors when I was quite young that used to say, Erica, I found this out only in my late 40s or early 50s, but you should know that you're a relationship builder and it is a huge asset to any company. And
also doing it in an authentic way. I mean, I think there's a lot of people all over the world who kind of brand themselves as
hyper networker.
Exactly. But how do you do that in an authentic way where it's not transactional? And it's literally just like, hey, I want to be helpful to you.
Yeah.
As a human being, The only thing I require is a thank you. That's it.
Yeah. Yeah, I think it comes back down to authentic values of what is your purpose. And for some people, they're trying to get somewhere and you can feel it, which is pretty icky for people like you and I think. And other people are just, hey, this is exciting. Let me build, collate, coagulate and see what happens. Yeah,
100%.
I love that. And so then angel investing.
So it started in 2013, almost 11 years ago. And by we, I mean we're 4 founding partners. So Tamara and I went to college together, so we know each other for a long time. Mm-hmm. And then the other 2 partners are Sonia G and Sunil. So we're 2 Sonias at the partner level, which gets confusing. So I'm Sonia W, she's Sonia G. The 4 of us started angel investing together. And what we found was that there was a gap at the time, keeping in mind that the ecosystem is completely different to what it is now. Like there are very few players doing early stage tech investing at the time. But what we found was that there were a lot of young professionals like us who wanted to invest in the space. And so we started hosting kind of these informal meetups, invite interesting entrepreneurs, invite our friends, and then our friends started inviting their friends. And then we organically grew into essentially the largest syndicate of angel investors in the region, deployed $30 million through that model.
Over how many years?
Over the first 3 or 4 years at the time. So we invested in about 100 companies. We invested heavily into Y Combinator companies at the time as well. And I think our USP was the fact that we weren't focused on this region necessarily.
Yeah, I saw that it was quite global.
Yeah. So
mostly US?
US, India, Africa, Europe. I mean, really what we did well was put our ear to the ground and understand kind of what do our investors want to see. And some of them felt most comfortable investing in the region. Others did not feel comfortable investing in this region at the time, right? And so sourcing the deals accordingly and then having the entrepreneurs pitch accordingly. And then it made sense for us to pivot into a VC model. And then we chose intentionally to be thematic from the get-go.
Tell me why not stay in the angel side? What's the difference? What was the strategic decision to go, we need to be a VC now?
Well, we wanted to institutionalize the way we were operating at the time. There's no business model around it. We didn't have membership fees. Like, we only charged a carry, so it was purely performance-based. So, like, there was no kind of coherent business model around it. And so if we really wanted to turn this into us doing this full-time, we needed to make that pivot into a more institutional investment player. And so it made sense. But by then, I guess the beauty of our story, which I think is quite unique, is we didn't wake up, the 4 of us, and say, let's launch a VC together, We did this on the side, and then we organically evolved into a VC as the ecosystem in the region was growing itself. So we were catering to the needs of the region. And so we started with kind of the angel investor base, which is still very needed at this point, right? Even today. But then it made sense for us to grow up, into a VC, because even at the time then there weren't that many VCs out there, right? I think now we're at like 70 plus investment type entities across mainly the GCC. But at the time there weren't that many players. And so then we decided, so we had been generalists before with a kind of global mandate. through that had built our chops, I guess, across different sectors. There's certain sectors that we felt there was a huge opportunity in that was still uncatered to in the region. And so fintech was that. And so we launched the first sector-focused fund in the region and decided to focus that fund on fintech in the region. In parallel, we also launched the first impact vehicle. That was me kind of exploring what does VC with an impact lens look like? And is it palatable to investors in this region? Do they understand that you can invest in mission-driven founders who are building tech-enabled businesses that will have long-term, meaningful outcomes, whether it be environmentally, societally, or economically, and also get a VC return at the same time, not a concessionary return.
And when did you close that impact fund?
So that was closed in 2021. That's fully deployed. So both those vehicles are fully deployed.
It's fully deployed. And was it difficult to fundraise for that? Or, it seems like everyone's on.
No, it was a smaller vehicle. So for us, it was more of a beta fund to test the market out. And it was pretty easy for us to find like-minded investors who put in, mainly like family offices and high net worth individuals who put in. And we have partners from other regional VCs actually here who even put in their personal money. So no, it wasn't difficult to find kind of like-minded souls, if you will. And it was not hard to either find the companies to invest in. So that had a global mandate. So we invested from Indonesia to Chile. We have our first unicorn in the portfolio already. We have great case studies that we can point to in terms of performance and companies themselves. One of them has expanded to the region already and set up an office in Abu Dhabi. So they're doing all the mangrove restoration work.
That's
Dendra.
Yeah.
So, but yeah, so they're rocking it. So really for us, we really roll up our sleeves, I think, with international companies who want to expand to the region. That's kind of also our USP in a way.
Yeah, that is quite rare amongst the VCs here. I was going to ask you that in terms of, you're MENA based, but are you MENA focused, or what percentage of your investments are actually today in the region?
So now with the thematic funds, it depends. So Fintech Fund 1 focused on MENA, Pakistan. Fintech Fund 1 is backed by all the sovereign wealth funds in the region, by the way. So PIF, Mubadala, ADQ, Al-Waha, and a bunch of family offices. And that had a MENA plus Pakistan focus. Impact was global, but focused on climate and financial inclusion. And then Fintech 2 is MENA focused, but with adjacent markets included Bangladesh, Pakistan, Sub-Saharan Africa. And then now the subsequent Climate Tech Fund is Global South focused. So really Southeast Asia through South Asia into MENA down to Sub-Saharan Africa with pretty much equal allocations to each kind of regional mandate.
Okay. And roughly, what's your average check size? We've already covered sector, growth stage.
Seed Series A, 500K to 2 million. We obviously keep some capital aside for follow-ons as well into Series A, Series Bs.
Okay.
Yeah.
Yeah, I have seen some later stage investments from you as well. So it's always...
And we do co-invest, of course. Yeah.
Okay. So you sat in the angel investor seat, and now you've sat in the institutionalized venture capital seat for a while. If you put yourself in a founder's shoes and they're thinking, okay, I'm a first-time founder, first-time fundraising, I'm being told over here I should go talk to some angel investors. I'm told over here to go talk to some venture capitalists. What's the pros and cons of each?
Well, I think if it's your first time fundraising, regardless of whether you're a first time or second time founder, you should go to angels first. Because you start with a friends and family round, right? So again, depending on where you're at with your product, have you already built the product or are you in the middle of building the product? Because if you haven't built the product, it's unlikely that some of the VCs here will look at you until you have built the product and see some level of traction. So typically, I would say go to there's different angel groups in the region that you can go to. In addition to your own network as a founder, whether it be friends or family, start building the product out, start getting traction, and then graduate to the more institutional funding.
The larger rounds.
Yeah.
I've also seen some players, particularly in India, but globally, that are raising, later rounds. Let's say a Series A. It's still early stage, but Series A, or a pre-Series B, and they've actually gone out to 20 high net worth individuals that can give them free marketing for their product, especially consumer-focused ones. What do you guys feel as a venture capitalist when there's already a bunch of 20 angel investors on a cap table?
I think eventually, at that early stage, it's fine. I think eventually down the road, as the company goes through their fundraising journey, BC onwards, you will have to clean up that cap table. And also, to be fair, I think some of the angels who maybe seeded or preceded the companies will actually want exits too, right? So it's an opportunity for them to exit their stakes and sell to the later stage investors as well. So so that's kind of what I think. I think listen, like the sources of funding are so varied now, right? You don't have to go to VCs. Like if there's strategic family offices or strategic high net worth individuals that you have access to, access being the operative word here, then you, by all means you should, right? Each will have different levels of sophistication. Like, maybe a high net worth will not look to lead around necessarily, and they will look to some sort of validation from it being led by a VC, and then they will either match or put in money. But it's all about access ultimately. And so if you have access to like 20 high net worth individuals, and they're strategic, then go for it, right? Okay. As long as you need the money.
And VentureSouq, do you guys lead rounds?
Yes.
Yeah.
Do
you prefer to lead rounds?
I think it depends. I think for regional deals, it makes sense for us to lead rounds. So we've led rounds in Saudi, for example. For climate, it'll make sense for us to lead rounds also in MENA. So it depends on the kind of round terms. It depends on the sector and
where you guys feel most proficient.
Yeah, where we feel most proficient, and also timing. Like that's also a big thing for VCs, right? Who's looked at the deal? Is there someone else that's already leading because they got access to the deal earlier, or is VentureSouq have access to the deal earlier themselves and then will look to lead? Or is there no one wanting to lead, and then VentureSouq comes in and kind of dictates the terms with the founder?
Okay. So the perfect pitch, according to Sonia, what's included? There's a bunch of founders out there that are knocking at your door, and they're going to watch this before they show up.
Yeah. I think you can find a lot of this online, to be fair. Obviously, like have product, have competitive landscape, have go-to-market in your deck, have team, obviously, and have vision. Those are kind of the basics, right?
For you specifically, where you're like, I need this. I want to see this. This is my magic dust.
Well, I put a lot of weight on the founders specifically, because ultimately that's who you're betting on at the early stage. So who are the founders? What's their background? Why are they doing this? The why is very important to me, actually. Like, what is motivating you to actually take on this entrepreneurial journey? Because it's not easy, right? And so what is the motivation, right? And I think that's important, because oftentimes entrepreneurs don't ask themselves that question, right? Like, are you doing this because you're trying to build kind of a $1 billion business? Or are you doing this because you're really passionate about the space and this is almost like a lifestyle choice for you? This is what you want to do for the long term. This is going to be your legacy. And I think that will also end up attracting a different set of investors, right? So if you're not looking to build kind of because funds have obviously short return horizons, right? It's usually a 10-year fund, right? So we have a fiduciary responsibility to our LPs to return money, right? So does it make sense for you to have an investor who has that timeline for the type of business that you're building? And if not, that's perfectly fine. There's other sources of capital that you can find where there might be more alignment with what you're looking to build. So I think like founders need to ask themselves that question first before they even go out and fundraise, because that will also dictate what their fundraise strategy will look like as well.
In that sense, I don't want to out a bunch of VCs, but if a VC fund is actually coming to the close of their vintage, as a founder looking to fundraise, should I kind of steer away from that, because that fund actually needs to bring returns quite quickly?
No, because ultimately you're constantly fundraising as an entrepreneur, just like you're constantly fundraising as a fund manager too, by the way. People forget that. So you should be building relationships 24/7 with all the fund managers in the region or beyond the region, etc. Because ultimately it is a relationship management, also business. Like, it is, a lot of people say it's like marriage. Like, this is a long-term play, right? We're not kind of dipping in and out within a couple of years. Like, we're there to actually support you and be your ally in this relationship, and that's built on trust. And so, build a relationship with the funds at any point of their journey, I would say, with the fund managers is important, right? Especially if you might have better relationships with some fund managers than others, then start building the relationships with the other fund managers that you don't have close relationships with. That's very important. And I know it's difficult, and it's also, unfortunately, contingent on the bandwidth. Don't negate being put in touch with analysts, associates within the firm either. They have a huge say. And I think that, founders tend to always reach out to the partners they're the ones with the least amount of bandwidth and will be least likely to respond, especially if it's by LinkedIn and it's a cold pitch and whatever. Go source the analyst, the associate, the principal at that firm and start building a relationship with them, because ultimately they're the gatekeepers of the pipeline, right? So build relationships with them, and then and make sure that you're in the pipeline rather than always aiming for the... I mean, if you meet the partners, great, right? But I'm just saying, I just feel like there's not enough emphasis being put on kind of the younger generation of the firm, who really are the ones who are rolling up their sleeves, digging, looking for deals.
I love that.
Yeah.
Yeah, that's great advice. What's your biggest pet peeve when it comes to founders either approaching you, might be this one, or within the pitch itself, that you're like, this irks me and I'm doing you a service by giving you this gift of feedback?
I would say some of my pet peeves, old LinkedIn pitches where it's very clear that they have not even looked at our website. Like, we're a thematic VC. Like, don't approach me if you're building a healthcare product, unless it has a climate angle or a fintech angle to it, of course, right? So I often say, like, you know, just like we're diligencing founders should diligence the firms that they're approaching, because honestly, it's a disservice to them if they're pitching a fund that is thematic and they're building a product that has nothing to do with the themes that the fund focuses on. So that's one, I would say, is cold pitches that are irrelevant. What else is there? I think specifically for me, and this is a big if, but if founders have listened to other podcasts I've done or things that I've written, etc., then they obviously will know that I either focus on impact and or climate, right, as a space, greenwashing. So, you know, it's clear to me when people are adding slides on kind of superficial impact that they think that they're having, or, you know, so I think, again, it has back to the authenticity bit. Like, don't approach me if you think you're going to get a check from me because you could potentially do something that's climate related, you know, as an afterthought. That has to be embedded in the DNA of the company, what you're doing, right? From a sector specific standpoint. So I would say that's something else. I think if there's like a level of greenwashing that I sniff around, and that goes back to the why again. Like, this is also why I spend so much time trying to figure out why is this founder doing what they're doing, because that'll actually inform my assessment of whether it's something that I feel is authentic or not.
Yeah, it's a shame because the greenwashing bit shows that they've done enough research to know what you're after, but then they're actually being inauthentic by morphing themselves and their product to say, yeah, we're climate focused.
Yeah, and also keeping in mind that like we're the ecosystem is grown, but it's still relatively small. So like we know all the fund managers are friends with each other. Like we all hang out socially, even like, you know, some come to my house for yoga, for example, on the weekends. Like we all talk to each other, right? So if a founder sends one type of pitch to one fund manager, and then I see another version of this pitch that just has some like added slides, I'll figure it out.
Yeah.
So I think just be intentional in what you're presenting, and you know, ultimately it's your product. Like, don't bend yourself over to fit a specific thesis that a fund might have. Then maybe I'm just not the right person for you at this point in your journey. You know.
Sounds like dating advice.
It is. It does sound like dating advice.
It is, though, right? It's basically figuring out who the right partner is, and it's not saying I want to fit everybody here. As a founder of a startup, you really need to figure out what venture capital is going to serve you, and vice versa.
Yeah, and also like what type of value accretion are you looking for from your cap table? Like I've said it, you know, before. I'm sure you've heard me talk about, you know, see your cap table as really kind of a set of allies, right? Ultimately, none of this works without the founder, right? We as investors are incentivized to see the founder succeed because we've got skin in the game. We're invested in the founders who use us, you know, like let us roll up our sleeves and help you, whether it be on the fundraising side or on the customer side or the strategic side, etc. Like leverage. And that's why you have to be so strategic also in the cap table composition, right? Do you want like 20 investors of the same, or do you want 20 investors with different backgrounds, whether it be sector or geography specific, or maybe they just come with different types of expertise? Like, be thoughtful in the way. And I know it's hard because fundraising is difficult and you want to cast a wide net. But where possible, like, try to tier, try to be strategic and intentional on who you're approaching first. Why does this make sense for you? Because ultimately, like, you're going to want to pull these people in at different parts of your journey. And so who can be most helpful to you and who will be incentivized to do so?
Yeah, beautiful. Do you have to pull teeth sometimes with some of the startups that have come to you for funding, and a lot of them just go, okay, we have the funding, we get to work, versus those that actually pick up the phone and call you guys whenever they think they need something?
I think it's very difficult. I think that it's a very dicey relationship dynamic between the founder and the investor, because in order for founders to feel comfortable picking up the phone and actually, again, having an honest conversation with an investor and really opening up their kimono with that investor, they need to feel like they're in a safe space. And I don't feel like oftentimes that is the case. And so founders tend to be afraid of doing that, because ultimately they might need Sonia at the next round, or they might need more capital from that VC firm, etc. So how open do you want to be? Like, do you really want to tell that investor you're in trouble? My advice to founders is yes. Like, you should hopefully feel comfortable calling up whomever you're close to. You're not going to be close to all your investors either, right? But if you have at least a subset of investors on that cap table that you feel comfortable, just pick up the phone and be like, listen, I'm really struggling with this professionally, or even I'm really struggling with this personally, and it's affecting my work. That is key. And if you don't have any of those on your cap table, it's a bit worrisome, to be honest, because you need to have people that you trust, who will have your back and who can help you. And I've heard stories of, when founders not feeling comfortable when they're struggling on the fundraise bit even, and then, other investors finding out afterwards. Then their reaction is like, why didn't you tell us when you were struggling? We could have helped you, right? But for whatever reason, they don't feel comfortable actually sharing that with the investor, right? And so it's back to the whole, see this as an alliance kind of philosophy that I personally have. Like, yes, you should feel comfortable, and you should leverage the network that you have on that cap table of yours as a founder.
And there is that notion that it's actually the founders stepping into the vulnerability and expressing that actually creates trust.
Yes. But also the investor feeling comfortable with that level of vulnerability being shared with them. Not all investors are. I'm not going to say it's gender tied, because I know a lot of sensitive male VCs.
Yeah.
But it is tough. Like, how do you create that sense of safety and vulnerability and openness that a founder can have access to? Not many investors do it well.
And let me ask you, woman to woman, on the other side of the table, are you finding that female founders are a little bit better at this? Or in this corporate setting, just because of the power dynamics, I am getting money from this VC, I'm trying to create returns for them.
I think it depends. I really think it depends actually definitely I think that there's an affinity that's created female to female. So female founder to female partner, for example, or female principal or senior associate, etc. No doubt. But I think there are a lot of male VCs that I know, or within that team of principals and senior associates of, that have that level of self-awareness where they understand the importance of this safe space. And I'm not going to toot our own horn, but I do feel like a lot of the men on the VentureSouq team are like that. And so that's why there's a level of comfort maybe. And that's why maybe people, call us, we're friendly and friendly investors, etc., because people know that, we kind of have their back.
Yeah. Yeah. I love that. Radical honesty. I think we all need to step into that more and more. Considering all of the changes that have been going on, that we're at the end of, hopefully we're at the end of a VC winter, but we're, high interest rates, cost of capital is high, the frothy times of 2020, 2021, where every startup founder seemed to get investment somehow. These corrections and valuations we're seeing.
Right.
Yeah. Tell me what your thoughts on this are.
Well, I definitely think there was a bubble, that was inevitably going to burst, right? So, and people called it out, I don't think anyone's surprised that it actually happened, right? We didn't see it as much, touch wood. I think we were fortunate in the sense that we focused on the sector, even within fintech, that was emerging markets. So there was a need for innovation within the financial services space, right? So I think we were sheltered to some extent from some of what we saw in other markets in the West. With regards to impact and climate, we didn't feel, again, the same thing based on our own portfolio, maybe because we focus on sectors that are underserved from a capital injection standpoint anyway, and that were sheltered by the frothy bubbling that was happening in other sectors. So was the correction needed? 100%. Is it tough? Yes. And I think it's tough for fundraising as well, even for fund managers, right? But we'll get there.
In 2024, are you bullish or bearish?
No, I'm bullish.
Yeah.
I mean, again, you're talking to a natural optimist. So who believes that everything happens for a reason. So no, I am bullish. I think that, I think from a fundraising standpoint, it is still difficult. I think both on the fund manager side, but also on the founder side. Of course, like the wake-up call has pushed fund managers to be more diligent in their DD, for example, right? So
what are they looking at in more detail, or what are you looking at in more detail that you weren't? I mean,
no, we always looked, like we always had very thorough investment memos, etc. Like, we were the ones who were making a decision in 2 days to make an investment in a company and without actually looking under the hood, right? So,
okay, let me ask this question then. For a founder that may have raised funds in 2020 and had that experience, 2021, and they're coming back to raise funding now, how will this experience be different from their last experience?
It's going to be a lot more thorough diligence from most of the... It doesn't have to be only VCs, by the way, but from all the investment entities, there would be family offices, CVCs or corporate VCs, traditional VCs, etc. Like, I definitely feel like people maybe also are slower in their pace of investment. There was also a frenzy where people were deploying left, right, and center, right? So people are just more careful and thoughtful in the pace of deployment, and subsequently also just looking under the hood, which honestly they should have done from the beginning. But it's kind of back to basics, right? Like it's back to what it should be is my view on it, right? So I think like VCs should take the time to diligence, and founders should understand that diligence takes time. And again, back to the relationship building. Don't expect to just have one interaction with the VC and then halas, you're done. It's like, no, it's a work in progress, right? So
generally, how long would you say it takes from
diligence?
From the first meeting where it's like, okay.
It really depends on how organized the founder is. Like if he or she has a data room that's already set up with all the materials, like my advice to founders is just like you're building your product to make it as user-friendly as possible, make your data room as investor-friendly as possible, right? So have all the materials in there, preempt any questions that investors may have an FAQ document if you want, based on other questions you've gotten from other investors and where it's all consolidated in the data room. And that way you can preempt. It's all about time efficiency, right? So if you can preempt all the back and forth that happens on the due diligence front by having everything in there in a very organized manner where it's easy to find, etc., then honestly, like, it gives you a leg up.
Okay.
Yeah.
3 months?
Back to the timeline question?
Yeah. 6
months? I think, listen, if you have your ducks in a row, I think 2 months.
Okay.
Onwards.
Okay. That's pretty fast, actually, I would say.
If you have all your ducks in a row and everything is in that data room, and where we don't have to go search, look, etc., right?
And let's say, because I wouldn't say that that's the average time that it takes. What is the average time?
For what?
For a founder who is not so organized to...
I've had founders who are like, oh yeah, we have a bank account set up. It's still under my personal name. I'm like, nope, not going to fly. And that takes time then. Setting up a bank account here is no joke, right? For a founder. Yeah. So that depends. It could take up to 6 months, depending on what the corporate structure needs to be reorganized completely, because it's not set up for taking in institutional money.
Yeah.
Then that can take time, right? Depending on the jurisdiction, etc., that they go for.
Okay. You've been in the region for 10 years doing this.
13 now. Well, 10 doing this, yeah, but 13 in the region. Yeah.
13 in the region, 14 for me.
Yeah, crazy, huh?
Yeah. But 10 years doing this, angel investing and venture capital, you've seen probably a couple of second-time founders come around as well. What piece of advice would you have for all founders that, a couple of years down the line after you've invested in them, you inevitably see that they didn't realize the full scale of what they signed up to?
For second-time founders?
For first-time or second-time founders, just, I get this question comes from, it seems that a lot of startup founders just want to fundraise. Yeah.
I don't think they want to fundraise. I think they feel like they have to fundraise.
They have to fundraise, or it's some kind of badge of honor. It's some sort of, it's a badge of success.
I don't think it's a badge of success. Actually, I think it's out of need, right? Like, my advice to founders is, unless you need to fundraise, don't fundraise.
Absolutely.
Right? Because you're giving a portion of your company away.
Yeah.
And you're getting other cooks in the kitchen now that you may not always be aligned with. So that makes for a messy relationship. So I actually don't think it's a badge. Unfortunately, I think that a lot of the founders just need the money, right? And so where's the money going to come from? And so, of course, like if you are in that case, in that scenario where you need the money and you get money from reputable VCs, and of course, then it becomes like kind of a badge of credibility or et cetera, right? But I don't think founders set out and actually enjoy fundraising, unfortunately, because especially at the early stage, it takes up so much time. And so oftentimes it's the CEOs and the CTOs basically who are out fundraising, mainly the CEO or the CEO, kind of allocated person, which is usually one of the founders. They can't afford to hire someone to fundraise for them. And so it's actually very distracting from actually building the product at the same time, right? In an ideal scenario, you'd have someone dedicated to fundraising who's one of the co-founders. I mean, that would be the ideal situation, right? Because you are constantly fundraising. You maybe have just finished fundraising for your seed. You're already thinking about the Series A, depending on the runway that you have with that money, right? So I don't know if I answer your question, but I don't think it's a badge of credibility. I think it's a necessity.
I don't think so either, but I think out there in the world, even in the publishing space, right? Probably because this is the only data that we have to go on is such and such startup raised this many millions of dollars. And everyone's like, woo, on LinkedIn.
I think there's a lot of startups that you don't hear about who don't, kind of work the PR machine and who don't feel like they need to make announcements because they actually either raised privately within their own network, or because they don't feel the need to like shout it out necessarily.
Absolutely. Okay. So taking that, what have you noticed that when founders do fundraise from VCs and they're kind of mature, they've had a relationship with their cap table and the investors on their cap table for a year or two, what is it that most founders are surprised about in terms of what they're signing up for? I'm thinking, for example, a lot of startup founders, especially first timers, they don't realize that when they fundraise from VCs that there's reporting lines that need to be put in place. There's governance structures. Yeah. All of a sudden they can't just, be in the Wild West making all of the decisions. They actually have to make some phone calls before they make some big decisions.
Yeah, of course. I think there's the level of professionalism that needs to step up their game in, right? When they raise, especially kind of.
So paint this picture. What is a founder that raises funds from a VC giving up, let's say, or saying this
freedom? They're giving a part of their freedom, right? Also, it depends on whether it's a solo founder versus a co-founder dynamic. I feel like because what I've seen is solo founders tend to actually appreciate the fact that now they have people they can chat with who are invested. And so we've seen that in the past with solo founders we invested into where it's like, they want to call us up and strategize with us because they don't have that co-founder or the co-founders that they can do that with either. So I think, yes, what are they giving up? Freedom. I mean, they you are still doing what you are intending to do. And hopefully you don't have investors that are messing with that, by the way. I should be your vision, kind of your values kind of injected and into the company. But you have people that you can kind of lean on in the periphery that you can call on when needed in exchange for that giving up a part of your freedom. What else are they giving away? Aside from a portion of their company in equity, if they're raising an equity round, of course. From a reporting standpoint as well, like, yes, I mean, there's quarterly reporting. Like, that's something we're required to report on to our LPs, right? So it trickles down to the entrepreneur as well, right? So I think that level of accountability also maybe is something that entrepreneurs are not used to, especially when they jump from the friends and family round maybe to the VC round, where we are beholden to our investors to provide quarterly reporting. Therefore, we expect quarterly reporting from the founders. And so maybe whereas before they might do an annual update to their friends and family, like now they actually have to report. And then there's certain template for reporting as well that is provided by the VC that they need to fill. And maybe there's some metrics that they weren't capturing before that actually need to they need to capture moving forward, etc. Depending on the investor.
So on one hand, you're giving up some freedom, but on the other hand, it should be a bonus in terms of becoming more professional, and it should be
because ultimately, as you grow as an entrepreneur, but as you grow as a platform or as a venture, you will need to have and inject that level of professionalism, whether it be from a governance standpoint, from a reporting standpoint, etc. The more kind of sophisticated investors you get on that cap table, the more sophisticated they will expect you to be, and they will expect sophisticated information to be communicated to them as well.
Beautiful. Sonia, we could be talking about this forever, but what's your last piece of advice for founders out there, just especially in this climate today?
In this climate today, I think lean in on the investors that you have if you already have investors. See them as a board of allies that you have, while at the same time, take their advice, but ultimately it's your decision. You're the founder. It's your vision. It's your company. So it's kind of that delicate balance of at the same time putting your ego aside and listening, being an active listener to the information or the advice that maybe people around you are giving you, especially if they have skin in the game. But at the same time, also realizing that it's your decision as to whether or not you take that advice. Because ultimately it is your company, is your decision, and is your life.
Words to live by.
Mic drop. No, I'm kidding.
I appreciate it. Thank you so much for your time. Hey there. Thanks for joining this conversation. If you enjoyed that episode and you want to start researching potential investors for your startup's fundraising strategy, go to luciditynsights.com and sign up now to the startup registration package by clicking the plans button on the top right corner. We look forward to having you join our future conversations and checking out our additional content. Until next time, stay hungry and stay humble.